I have something important to tell you. The stock market is over, and you should get out now before our president triggers a full-blown recession. Now that's what the Main Street media wants you to think. That headlines are screaming disasters, that social media is in a frenzy, and right now, the biggest question on everyone's mind is, should I sell now before things get worse? But let me take a step back here and slow down. Because if you followed me for a while, you know that I don't do fear-mongering. I do strategy. And since many of you started investing because of the videos and you're looking at your wealth plan and the different ways you can be growing and preserving your wealth, I want to be telling you about what is really going on. Not just the panic-driven headlines. Because our job here at Lions Wealth to help you as a business owner to risk manage your hard-earned wealth. Now, here's the thing. Every crash has a reason. It's never random, and it's never just one thing most of the time. Now, it's really driven by three key factors. And here's what most people don't realize. That if you understand what is happening, you can position yourself to not lose, or not lose as much, and to actually start to make more money potentially in the future just because of some of the ways that you are looking at and anticipating these movements. Now, history has shown that time and time again, panic selling is the mistake and strategic investing is the opportunity in these downturns. And that's where wealth is built. So let's break down exactly what's going on here and what that means for you and your money and how you should make the right decisions now versus the wrong ones. Well, before we get into some of those elements, I want to talk through some triggers, some things that we're seeing right now that is highlighting many different elements of this downturn. Trigger number one, President Trump's his trade wars and economic fallout that is occurring because of that. You see, President Trump has always pitched himself as the ultimate deal maker, the guy who fights for the American job and plays hardball with other countries. But the trade wars that he has started could actually do more harm than good. And tariffs sound good in theory, but taxing foreign imports to protect American businesses also has an element of history that could backfire. And that's where, when we take a look at the last time the US went down this path in 1930, the government passed the Smoot-Hawley Tariff Act and slapped huge taxes on imported goods. Now the goal was to protect American businesses, but the result? An economic disaster. And other countries retaliated. Global trade started to slow, businesses collapsed, and millions lost their jobs. Now, what would have been a small recession turned into the Great Depression. So fast forward, we're a century later, and we're starting to see inklings of history repeating itself. Now in February 2025, our president announced 10% tariffs on Canadian energy imports and 25% tariffs on Canadian goods. Well, Canada immediately responded with their own tariffs. They put 25% charges on electricity imports to the US. And it really affected and will be affecting New York, Michigan, and Minnesota at the most. So here's where it seems like a small move, but why it matters is because tariffs make everything more expensive. Businesses have to absorb the higher costs that they pass on to you. So that means for you that you can expect higher prices on cars, on appliances, on food. And when household budgets get stretched and the economy slows, the longer the trade war drags on, the more damage it does. Not just to Wall Street, but to Main Street. Well, trigger number two then, that our president, his stance on NATO and the geopolitical instability that that's causing. Now, yes, markets don't react to the numbers, they react to uncertainty. And right now we have some significant uncertainty around here because this is a huge wild card. What happens when we pull out of NATO or back away? And the question that we are thinking about now is who defends the NATO allies? And yes, our president wants them to pay their fair share and to help out here. And that's where on the surface it seems logical. I mean, why should the US bear the entire burden? But the unintended consequence that is starting to project some of this uncertainty is that it could backfire and create what we call a power vacuum. Now, who fills that vacuum? Right now, we're seeing inklings that it may actually be Germany and some other Western European countries. But it could be Russia, it could be China, or some other nations that are waiting for their moment to seize control. And if NATO weakens, then that's where we can have some global instability start to cause some market panic. And we've already seen this with Russia and Ukraine. Oil prices spiked, the stock market did go down, and people started running for safety. And if NATO weakens, we could see some of these things happen more. Trigger number 3, that the market is crashing on purpose. Now this is a hypothesis, a theory, and it could sound a little crazy, but it still is possible. What if the market crash is happening and is engineered? Now President Trump has never been a big fan of high interest rates, and he calls them ridiculous, and he's actually attacked the Federal Reserve just for keeping them this high. But since the Federal Reserve is independent, there's actually, really on the political front, nothing that our president can do. So what may be happening is that if he makes the economic conditions bad enough, we can start to have the stock market crash. We can start to see recession fears spike. And if that happens, well, we have to force the Federal Reserve's hand. They have to cut the interest rates. They have to prevent the meltdown. And then our US government would actually be in a little bit better spot, is the thought. Because right now we have $36.5 trillion of debt. And when the interest rates are this high, servicing the debt skyrockets. So think about it this way. Imagine you have a $36,500 credit card company debt. It charges you 10% interest. Now, before you even start paying down that debt, you get hit with $3,650 for every year of interest payments. And if your interest rates dropped by just 3%, the annual interest payments would actually go down to $1,095. Now that's a massive savings, and it allows you to actually start paying down the debt faster then. So if the Federal Reserve lowers the interest rates, the government can refinance its debt at a cheaper rate and save billions. And that alone could be one of the smartest economic moves in history. So if the theory is true then we could actually take a look at a little bit of a temporary shakeup before a massive rebound. Well, this is where we have to know what market cycles are and how they work and how you can take the opportunity and use it to your advantage. Because here's one thing, market crashes are not rare. They are a normal part of investing. But if you don't understand them, it's going to catch you off guard, and you're going to have fear, and you're going to make bad decisions with your wealth. Now there's 3 phases of the market crash that I talked about a little bit earlier, and every downturn follows these phases. And the first one is the warning sign. You see, this is where the smart money, the institutionals, start to move out. And what they do is they take a look at the volatility. They find the clear warning signs, the economic data that's weakening, and they start to quietly pull their money out. Well, one investor that has quietly pulled out his money is Warren Buffett. So you call him the smart money. You call some of these large hedge funds and institutions the smart money, because they can be moving around with some of this data because they're well connected. But if you're paying attention to the market signals, you can actually see cracks form, and you can start to maneuver when the volatility starts to rise, the job numbers start to decline, and companies start to tighten their spending. Those are all classic signs. Well, the second one then that we see is the panic selling by the average investor. And this is where the media really starts to scream, and where we're starting to see that people who weren't paying attention wake up and start to say, the stock market is dropping, I need to sell it all. I need to get out, I need to make sure that I don't lose it all. And then we start to see millions of people start to panic and sell at the same time. Now this is where the smart money then starts to buy back in, because what they do, they see this as opportunities, just as you can. Well, the third phase then is the rebound. This is where we have the opportunities. You see, this is where we take a look at history, and every single crash in history has been followed by a recovery. And the ones who benefit from that are the ones who started to buy in at the bottom and stay disciplined. So they ignore the fear-mongering that's out there. And this was especially true in 2008. You see, when we started to be terrified that we couldn't get any better and we were going to continually get worse and worse, this was the exact time to start actually putting money to work in the markets. And why this matters right now is because I believe we're somewhere between the warning signs in the panic selling phase. And the media is pushing for this fear, the volatility rising, and all of these things for people to start dumping their stocks. But that's exactly the time that you need to be taking a step back and being prepared. And that is what I really want to emphasize. There are a couple things that you can do today to help to prepare your wealth for what's to come and some of the improvements that may be there in the future. Well, first thing you can do is take a look at the trend and the signal lines. Now, this is where we here at Lions Wealth, we don't want to be blind to all of this. And so we can get out of certain investments when they, what we call, break trend. Now, this is where it's just a mathematical event of where we have been with the different investments. And if they're above the trend lines, then there's a mathematical certainty, as much as math can be, that we are going to go up versus down. Now, I call that a certainty, but remember, this is something that there are different elements here. So mathematically, we're more in tune with going up versus down, but it doesn't always have to happen. And that's where we come back to the signal. And the signal then says, is this the right timing to be invested? So if we're more apt to be going up because we're above the trend lines and the signal doesn't confirm it, we don't need to be invested. But if we are below the trend lines and we're seeing that we are actually mathematically a higher probability that we'll go down in price, but the signal starts to say, you know what, things are changing, the pressure is easing on the selling, and we're seeing buyers step back in, that's where we can start to really take advantage. And so we've gotten some of our clients out of some very good trades with some high risk tech stocks. We have moved into other asset classes like gold and utilities, and even what I mentioned earlier, European stocks, because that's where the signal is pointing right now. And when we see the volatility high, we step back in certain areas, but we can provide some stability in others. Well, the second element then is to stay disciplined and think long term. Now, yes, you want your wealth to be able to be used today. We want to set it up correctly for today, tomorrow, and in the future. And that's where we can be taking a look at the trend and the signal lines and start to put some systematic money to work and start to actually buy in on a regular basis to those areas, and that will actually help you to better your overall wealth plan in the future. Third one then is to diversify your portfolio. And I know you know this, but it begs to basically be repeated here, is that sometimes when we're too concentrated, we have too much in one stock, too much in one fund, we can actually start to see how that diversification can help you to crash versus help you to stay and manage your risk. And right now there are a lot of mutual funds, there are a lot of exchange traded funds, there's just a lot out there that invest into, well, about the same 6, 7, 8 companies. So if you actually take a look, some of your growth funds will be invested into Apple in the same way some of your value funds are. And you may actually think you're diversified, but if you take a look under the hood, you may not be. And that's where, when you take a look at stocks and bonds, gold, real estate, structured notes, alternative investments, options strategies, hedging strategies, dividend paying stocks, all of these don't move in the same direction. And that will help balance your risk. You see, that's where we can do the most good, is by making sure when one is going down in price, we have another right there that can go up just to help with your risk. And what I said before is that market crashes aren't the end, they're the opportunity. And people who panic now and the ones that take the losses, those are the ones that may be hurt for days, months, years to come. The ones who start to invest, they stay smart, look at the right signals and trend lines, they can actually come ahead. So this is what I wanted you to learn today, that right now there's a lot here, and we do have a lot on this channel, so please subscribe to our YouTube channel and make sure that you are liking this so that others can find this and really learn about how they can better their opportunities. And also, if you or someone you care about would like to have a second opinion on your overall wealth plan, or just bouncing an idea off of us, please feel free to reach out. We'd be happy to talk. Now, as you are looking at all the different ways that you can better your wealth plan, we've selected this video right here just for you. We'll see you there.